Good afternoon. Thank you for coming. Before I forget, this event is being organized by the Financing for Development Office as part of the preparatory process for the third International Conference on Financing for Development to be held in Addis Ababa in July 2015. My name is Bat Bolt. I'm a staff member of the Financing for Development Office. My colleague, Peter Chawla, and some senior colleagues were supposed to come, but some unforeseen things came up. But hopefully my boss will try to join later for the discussion part. With that done, on behalf of Mr. Alex Terpilkov, our director, I would like to welcome Professor Collier to the United Nations and thank him for taking time out of his busy schedule to give this talk. And we are really privileged to host your talk on this important topic of great relevance to the Financing for Development process, and especially at this particular time leading to the Addis conference. Professor Collier doesn't really need much in terms of introduction, at least to this audience, because he's so well known an author on development issues within the international development community. Anyway, he's a world-renowned expert on governance in low-income countries, especially in political economy of democracy, economic growth in Africa, economics of civil war, aid, globalization, and poverty. He was knighted in 2008 for his contributions to scholarship in development and was cited as one of the top global thinkers by Foreign Policy magazine in 2010 and 2011. He was the director of the Development Research Group of the World Bank from 1998 until 2003, and is currently director of the Center for the Study of African Economies, the International Growth Center, and serves on the advisory board of Academics Stand Against Poverty. Probably most people know him through his books, The Bottom Billion, which in 2008 won several prestigious awards, and his second book, Wars, Guns, and Woes, Democracy in Dangerous Places, was published in March 2009, and his latest book, The Plundered Planet, How to Reconcile Prosperity with Nature, was published in May 2010. But particularly relevant for us is the fact that in recent years, he has been a leading author and advisor on harnessing natural resources for sustainable development, advising the IMF, World Bank, many governments, in particular in Africa. And his recent research papers include such titles as Commodity Prices, Growth, and the Natural Resource Curse, Reconciling a Conundrum, Managing Resource Revenues in Developing Economies, Managing the Exploitation of Natural Assets, Lessons for Low-Income Countries. In today's lecture, he will address the challenges resource-rich countries will be facing in the coming years and the lessons policymakers and the international development community can draw from the ending of the super cycle of commodity prices. Professor, you have the floor.
Thanks very much. I was here this morning to address the Africa group, and so this was a convenient thing to coincide. I'm going to talk mainly about the financial implications of natural resource exploitation for development, but then I'll close with some broader remarks about finance for development in general. So let me start with focusing on the natural resource issue. And it's very timely to take stock of what has happened on natural resources, because we've just completed the strongest commodity cycle that the world has ever experienced. The last 10 years, the cycle of commodity prices was so pronounced that it was described as the super cycle. And when we were in it, some people thought it would go on forever, and now it's over. And the collapse in oil prices is the sort of final nail in the coffin, but it's, in one sense, a convenient nail that it concentrates the mind. We've had a decade of a super cycle, and so it's useful to take stock and to compare it with the previous commodity boom cycle when I was a young guy, and that was from the mid-70s to the mid-80s. And when that finished, there was a strong sense in a lot of low-income countries that that had been a missed opportunity, that cycle of the mid-70s to the mid-80s. I remember I was working on Nigeria at the time, and there was a sense of never again. We've missed this opportunity. And basically the world then had to wait another 20 years before another cycle came along. And indeed, that's, if we look at the long history of commodity prices over more than a century, the normal state of commodity prices is to be gently depressed. And then now and again, you get these boom cycles, stockouts, when prices go up a lot, and then they come down. And so the cycle, the boom phases, which last for maybe a decade, are a huge opportunity, because whilst that's happening to prices, the rents on commodities, the cycle is much more pronounced. When commodity prices double, the rents much more than double. And so the boom phase is the phase when the rents are concentrated. So making use of those boom phases is hugely important. How to make use of them? Well, partly you've got to capture them, and then partly you've got to spend them. And I want to focus mainly on the spending side. Let me start with a few words on capture, on taxation. And I think that taxation is now going better than it did 30 years ago. But it's still a battle. I think one key thing that's happened is that there's now an alignment of interests, not a perfect alignment, but a reasonable alignment between poor countries and rich ones. Because the governments of rich countries are now suffering from the same tax problems that poor countries have been suffering for quite a long time. Namely that international companies are able to avoid tax liabilities. And that's been true for many years in low-income countries, but it's recently become much more of a pronounced problem in high-income countries. And at last, the high-income countries' governments have got concerned about that, and so are starting to do something about it. And a number of agencies around the world are in this battle, including the UN, but the leading edge of the battlefront is the OECD, the BEPS study, that is the base erosion and profit shifting work, which is due to complete in September. And it's really important to get behind that, to support what the tax group at the OECD is doing in trying to combat corporate tax avoidance techniques. And the first phase of that really is mutual wins. Pretty well, all the things that are good for OECD governments are also good for poor countries. So it's partly a matter of stopping the base being eroded, partly a matter of stopping the profits being shifted. And what was originally designed as a set of instruments to avoid double taxation has now become a technique for double non-taxation. And part of the problem is what's called treaty shopping. There are a mass of innocent-looking collaborative tax treaties between countries, and companies can then shop as to which of these treaties is most advantageous, and thereby shift profits into environments in which the profits are legally not subject to taxation. The most extreme version of that is, well, there are a number of extreme ones, but the one that's caught the popular imagination is called the double Irish, which enables a company to disappear for tax purposes. In effect, it moves to Mars. So this phase really is collaborative and win-win. Once this phase is completed, there'll be a second phase, which is much more of a battle between developed and developing countries where you don't have an alignment of interest. And that is the distinction between whether you tax based on the source of profits or the residence of the company. And the rich countries have an interest in the residence taxation, and the poorest countries have an interest in source. But it really is chicken feed for the rich countries to agree to a degree of source taxation, at least for low-income countries. But that is a phase two, and it's much easier to tackle phase two once you've had a cooperative phase, phase one, of stopping the base erosion and the profits shifting. So for the moment, I would advocate everybody align in that phase one, where the opponents will be companies and not governments. Just to give an example, there's $2 trillion of American corporate taxable income sitting in Bermuda, growing at 200 billion a year. And it's very much in the interest of the US government to do something about that. So that's the taxation side. What I want to focus on is the spending side. And here I think things are not going anything like as well. The key concept here is of stewardship. Natural resource revenues are intrinsically unsustainable. And the only way they can be converted into something that's sustainable is by using the revenues to accumulate assets. And there are three reasons why the revenues should be used to accumulate assets. The most obvious reason is that there is indeed a cycle. The rents go up, the rents come down when the prices go up and down. And so it's sensible to save in good times so that you can cushion the bad times. And a lot of governments are kicking themselves because they didn't do that. The poster child here is Chile. Chile is the country that sort of got that right, the smoothing of the cycle. That's the easier part of stewardship. It's still not easy because it does mean not spending as you go. But it's relatively easy in that you're only saving relatively short term. You're saving with the intention of cushioning years when revenues are low. The harder and more important aspect of stewardship is that revenues are unsustainable, not just because prices wobble about, but because the rents on natural resources run out. And partly they run out because of physical depletion. Cameroon, for example, has pretty well exhausted its oil. But mainly they run out because of completely unpredictable events around obsolescence. I was in Chile recently, invited in to talk about copper. And although Chile manages the price cycle very well, it is totally unprepared for an obsolescence shock, technological obsolescence. And it's ironic that Chile is unprepared for that just hasn't thought about it, because Chile has already experienced one of the biggest natural resource rent obsolescence shocks in history, and that is what happened to nitrates. For 30 years, from the 1880s to 1920, Chile got more than half of all government revenue from the rents from nitrate exports. And then in 1920, a German scientist developed synthetic fertilizer, and that instantly killed the rents. The rents collapsed. And so Chile had a huge fiscal shock, and those rents never returned. And that's pretty typical for natural resources. Sometimes they run out physically, more often they become obsolescent in some respect. That's going to happen, for example, with oil and coal once the world starts to regulate on climate change, on carbon emissions. And so a lot of assets will just become stranded, they'll become worthless. So the only way in which these unsustainable rents can create sustainable development is if they're used to acquire assets, to accumulate assets. The poster child of a government that does that is Norway. And Norway did that through a sovereign wealth fund. Now that is quite a fashionable concept. The sovereign wealth funds are growing, or the number of sovereign wealth funds is growing quite rapidly. In my view, is growing too rapidly, because although it was very sensible for Norway to create a sovereign wealth fund and park the money abroad, it would be pretty foolish for a low-income country to do that. Low-income countries should indeed use the revenues from natural resources to accumulate assets, but the assets should be investment within the country. Now here's the distinction between smoothing the cycle and offsetting more fundamental unsustainability. To offset the cycle, you indeed need to save abroad, the sort of stuff that Chile has done. When prices are high, you save abroad. When prices are low, you pull the money back into the budget. But to offset more fundamental unsustainability, you're going to run out of oil. Copper is going to become technologically obsolete, either because we get different ways of conducting electricity than the need for a lot of copper wire, or because we discover how to lift copper off the seabed. These are the sort of technical changes which would wipe out the rents on copper. To guard against that, it's more sensible to build assets within the country if you're a poor country, because if you're a poor country, you're short of capital. But in order to invest productively within your country, you have to build the capacity to invest well. And that's the phase I call investing in investing, building the capacity to do good domestic investment. especially good domestic public investment. And most low-income countries don't have that capacity. And so good stewardship means these three things. One is save the money, or save quite a high proportion of the revenues. Second, decide to use those revenues to invest domestically. But thirdly, before you do that investment, make sure you've built the capacity to invest well. So that's the stewardship challenge. And there's a very simple number that every government should know if it's got natural resources, and at the moment none does. And that is the proportion of resource rents, the revenues that accrue to the government, the proportion of those revenues that is used to accumulate assets. What would be sensible if there was a standard international methodology to work that number out? This is something the IMF could easily do. Basically, it should be a website where with one click you can find out what your country's done this year and what other countries have done and what your own country did last year. And there isn't. It's a subtle, it's not that difficult to estimate, but it's also not totally straightforward. I'll give you an example from Ghana. I was recently in Ghana, and amongst others, I talked with the two economic committees of Parliament in Ghana. And the members of Parliament said, oh, but we know how much is being saved out of our oil revenues because we've legislated that 30% of oil revenues should be saved. And indeed, there's a sovereign wealth fund that Ghana set up, and 30% of the money from the oil revenues goes into that pot, oil fund. So superficially, it looks as if 30% of the revenues are being saved. But you can only tell what the overall fiscal position is, how much is being saved, by looking at the whole fisc and not just a flow of a particular bit of money into a particular pot. So at the same time that Ghana put $200 million into this pot called oil fund, the government went out and borrowed $2 billion in sovereign bonds on the strength of the oil revenues, and that $2 billion was used predominantly to increase public sector wages by 50%. Meanwhile, overall public investment as a share of GDP fell. So since the oil revenues have been coming in, public investment as a share of GDP is lower than it was before the oil revenues started. So it's actually hard to sustain the argument that 30% of Ghana's oil revenues have been saved. Indeed, it might be, unfortunately, the case that less than 0% of Ghana's oil revenues have been saved. Debts have gone up by $2 billion, and asset accumulation overall seems to be, if anything, lower. Now that's the sort of number that, if it were being produced, might well have changed policy, because people in Ghana just didn't realize. Certainly none of the people on the economic committees of Parliament realized. They got it straight away once I explained it, like I've explained it to you. But it would be so much easier if an organization like the IMF just put that number out, put the concept out. So that's the concerns about stewardship. And it's serious because for the poorest countries, the resource revenues of the last decade have been a huge financial opportunity, the biggest financial opportunity that they've ever had. And so we really need to learn the lessons, to draw the lessons from that, so that next time this opportunity comes along, it is taken. And for some of these countries, the opportunity continues even though prices are lower, because they've discovered a lot of new stuff, and so they'll be getting a quantity boom even if they don't get a price boom. Let me turn to the other issue of natural resources, which I think is really important, and that is communications with citizens. And the paradox is that over the last decade, there's been one big success in communication with citizens, and that is to introduce the idea of accountability to citizens. And so governments around the world are now much more accountable to citizens than they were 10 or 15 years ago. And the paradox is that in the context of natural resources, accountability to citizens can actually be dangerous unless it's coupled with building citizen understanding. If you have accountability to citizens, but citizens don't understand the issues, that accountability can actually drive governments into irresponsible policies. So the starting point here is managing expectations. So I'm going to do 3 issues of communications. The first one, managing expectations. And there's a big challenge here because companies do resource discoveries and they have their own reason for exaggerating what they find. By exaggerating the value of what they find, they push their share price up. And typically companies will report figures in billions of dollars, billions of barrels, trillions of cubic feet of gas or whatever. And these are mesmerizing numbers that then get reported to citizens. And so citizens understandably interpret that as we're rich. And that is often very, very misleading. I'll give you the example of Exxon in Liberia, very poor country, where Exxon paid $50 million signature bonus to go and prospect for oil off the coast of Liberia. And so this got reported as $50 million. And for the average Liberian, that sounded like a huge amount of money. What ought to have been reported, but of course the companies had no interest in that, was to say typically only about 1 in 10 of these wells that are drilled actually find anything. And so the chances of finding anything in Liberia are not very high. Don't count your chickens before they're hatched. And indeed, nothing has been found. And $50 million, although it sounds like a lot, is actually $12 per head. So all that Liberians have got from oil over the last 5 years, and probably all they'll ever get, is $12 per person. If it had been reported like that, it would not have caused sensational expectations. But $50 million did cause sensational expectations, and that put a lot of pressure on the government to deliver. Citizens were saying, where's the benefits? And of course, because they don't see $50 million in their own pocket, they think it must be in somebody else's pocket. And so just simple measures for managing expectations, of which the most straightforward is reporting that number. What is the revenue per person from the resource rents that have been received by the government? I actually did a survey in Ghana to see whether, I did a survey of 1,000 Ghanaians to see whether they knew what oil revenues per person was. And 2/3 of respondents just said, we've no idea. And the other third, there was a distribution about as wide as this table. In other words, people had absolutely no idea, even if they thought they knew a number. I asked a very senior politician in Ghana who went to his desk, got his pocket calculator and tried to work it out. In other words, just nobody seemed to know. So expectations could be managed much better than they are. Second, managing ownership. It's awfully important to resolve the issue of who owns the natural resource. Is it national? Is it local? I'm from Britain, which is a country that's over 300 years old, that just a few months ago came within a few thousand votes of being dismantled because of a dispute as to who owned the oil. Was it a region of the country or was it the whole nation? And Britain's catastrophic mistake was that that issue was not resolved before the oil was found. Once you've found the resource, you always find it somewhere, and if you leave it till it's found to resolve who owns it, it's obviously too late, because then self-interest sets in. And so the right time to resolve ownership is at the prospecting stage. That's what the first president of Botswana did, Susuretsi Khama. At the time of prospecting, he convened all the clan leaders and said, we don't know whether we got any diamonds, we're going to look, can we agree that wherever we find them, they belong to everybody? The clan leaders thought about it, realized that was the best strategy, and it's never been an issue in Botswana because it was settled before the discovery stage. Final communications issue is back to stewardship. What's the proportion of the revenues that are saved? It would be awfully helpful if that number was actually out there in the public domain. It's a perfectly winnable thing for governments to explain to citizens that not all the revenue should be spent on consumption now. After all, households have children. They automatically think long term. And so an argument which says we're going to use a lot of these revenues to build a better future for our children is perfectly acceptable. After all, it's governments that have elections, households have children, and so automatically think longer term. But if that issue of stewardship isn't framed as that issue of use these unsustainable resources to benefit our children, what sets in instead is this sense of deep suspicion of government. If we're not seeing the benefits now, they must be being stolen. So those are the communications challenges. And just to summarize that, accountability without citizen understanding is actually takes us from one problem into another problem, from the frying pan into the fire. Yes, we have to have accountability, but it has to be accountability to a critical mass of citizens who understand the issues. So much for natural resources and the huge potential for financing development in poor countries that brings. Even with the lower prices, it's still a live issue in poor countries because in the last decade, so many natural resources have been discovered in poor countries. And so many of them, even with lower prices, will still get quite big revenues. Finally, let me turn from natural resources to a few comments on the larger issues of finance for development. And I'll just make a few points here. One is that a lot of poor countries have rushed straight from concessional finance to commercial finance with nothing in between. So straight from grants and concessional loans to sovereign bonds at commercial interest rates. And there are two really disturbing things about that. One is that sovereign bonds don't come with any commitment technology that ensures that the money raised by the sovereign bonds is actually used for investment. And if the sovereign bond revenues are not used for investment, the country is inevitably building a debt problem. Even if the sovereign bonds are used for investment, the country may well be building a debt problem because in the typical low-income country is only capturing less than 20% of GDP as tax revenue. So just think of the maths for a moment. If you're paying 8% on a sovereign bond and you're only capturing 1/5 of the revenues that are generated by the investment from the sovereign bond, even if you invest all the sovereign bond would need to yield 40% in order for the government to be capturing 8%. And that would be the break even for paying back the bond. So commercial sovereign bonds are pretty dangerous animals, I think. The world risk-free interest rate at the moment is approximately 0. And so pretty well everything that low-income countries are paying on sovereign bonds is a risk premium. And that's why sovereign bonds are really not a very good idea compared with IBRD. IBRD is the risk-free route to government borrowing. And it's, in my view, very unfortunate that low-income countries are very largely shut out of IBRD. IBRD is actually dying because it's still confined to a sort of middle-income country club that doesn't need it, when it should be open for the lower-income emerging market economies that move on from just concessional borrowing and grants to IBRD terms. Borrowing at IBRD terms is very much more viable than borrowing on sovereign bond terms because you're not paying that risk premium. IBRD is still AAA rated. So that's one very important thing. Also, IBRD could come with a commitment technology which ensures that all the money raised by the IBRD bond is used for investment purposes. an investment bank issuing a sovereign bond isn't in a position to get a government to build such a commitment technology, whereas the international financial institutions are in a position to work with a government to build a commitment technology that says this money will be ring-fenced for the accumulation of assets. I've got two other concepts and then I'll stop. So the second concept is getting private finance into infrastructure in poor countries. And the infrastructure needs in poor countries are enormous, way beyond what public capital can finance. And so there's a big need to attract in private finance. And at the moment, very little money is flowing. And so the challenge is to build a governance structure which makes it possible for private finance to flow in a big way into poor country infrastructure. I've got recent writings on this, which I'll pass on to the UN so that can be shared, and it'll be on my website. But the essence of the idea is to split the typical infrastructure project into three phases. The phase which gets you to yes, the negotiate phase, the phase which builds the project, and the phase which operates the project. Getting to yes, at the moment, typically can take anything up to 8 years. It doesn't need big money, maybe $10 million, but it's very high risk. The right agencies to do that would be the public risk capital agencies like IFC. And historically, they haven't done that. Historically, IFC has defined its role as sitting back and waiting for private projects to be presented to it. And so agencies like IFC need to get into catalytic mode, trying to catalyze projects instead of evaluation mode. And that's a big culture change in these organizations. The second phase, the build phase, is big money and pretty high risk. Because it's big money, you have to get some private money in, but because it's pretty high risk, you have to reduce the risks faced by private capital. And you can do that by public risk capital top slicing risks and by public risk capital providing insurance. So again, this will be roles for IFC and MIGA. MIGA doing the political risk insurance, IFC top slicing risk. The third phase is the operate phase. And in principle, operating a utility should be fairly low risk. So this is owning a utility is big money, but should be relatively low risk. This should be suitable for OECD pension funds. Or for that matter, the UN pension fund. But in order to make it acceptable for pension funds, the risks have to be brought down, the risks of operation, and that means a reputable operator, and reputable operators won't go to poor countries to run utilities because the regulatory environment isn't properly in place. And so the challenge here is to build a reasonable regulatory environment which brings in reputable operators, and then the high-risk capital that's used, private capital that's used in the build phase, can exit. It's very important that the high-risk private capital exits quickly, because high-risk private capital is very expensive. At the moment, the little bits of private capital that are going into infrastructure in low-income countries are not only building it, but they're expecting to operate it. And they're looking for rates of return of about 20% a year. And the only way you can get rates of return on infrastructure at that level is if the charges for using the infrastructure are way higher than world levels. And that's why you have to de-risk the operating phase. So that's private finance for infrastructure. And my final comment concerns getting private investment, not for infrastructure, but for anything, private investment into fragile states. Fragile states, in my view, are the core development challenge of the 21st century. Fragile states are both disasters for the people who live in them and regional public bads. They're bad neighbors. And so there's a huge global public interest in getting countries out of fragility. We know that development really only happens with an active private sector, with private investment. Public money alone cannot develop countries. But private investors don't want to go to fragile states. What's more, private investment in fragile states is not just risky because the state is fragile, it's risky because the investors are typically pioneers, in the sense that they are the first investor of their type in the country. And because they're the first, they're the pioneer, if they succeed, they get copied. Now that's a very valuable role socially, but it's very bad news for the pioneer themselves. If they get copied, then the profit, if it makes a big profit, they'll get copied, and that will reduce the profits. And if they make big losses, other people will learn not to lose their shirts, right? But that doesn't help the guy who's lost his shirt. And so pioneer investors inadvertently in fragile states are socially very valuable. They don't mean to be, but they are. They're creating a lot of benefits which they themselves don't capture. And therefore, there aren't enough of them. And so we need to devise some method to compensate pioneer investors for that valuable externality. And at the moment, we haven't got any mechanism for channeling public money to pioneer investors in fragile states. And we need one. So those are the three concepts on tapping private finance beyond the realms of natural resources that I wanted to put on the table. Just let me leave you with that concept that the 21st century just has to tackle fragility. If at the end of the 21st century we've still got South Sudan's, Somalia's, Afghanistan's, our children, our grandchildren are going to say, what on earth were you doing? Right? We will bequeath them a nightmare. Thank you.
Thank you very much. It was really, this is our opportunity to take advantage of Professor Collier's presence. And we have about, 15 minutes? So please think about your questions. I will start off with one clarification and one question. You said the rents double, more than double when the commodity prices double. Can you clarify that?
Yeah.
And my question is, just something I'm working on. These resource-rich countries seem to be in a disadvantaged position both because of the underdeveloped state, but really the volume of this resource boom would be overwhelming for almost any management capacity of a country. And it's exacerbated by the markets. When there is a boom, the capital markets want them to borrow, and the pressure, political pressure is so hard. So one idea we are considering is, this, as you propose, sovereign development fund, sort of Botswana Pula fund type, which is restricted to investing into public investment projects. But my reading from international financial institutions seems to be they haven't embraced this idea. So is a sovereign development fund restricted to using resource revenues for public investment only? Is a way of improving assistance by multilaterals to these countries?
Yeah, okay. So let me first the clarification that when commodity prices double, why do rents more than double? And the very simple reason, which is that rents are the excess of value over the cost of extraction. So if you take, what should we take? Iron ore. Suppose it costs $60 to get a ton of iron ore out of the ground and it sells for 90, then the rents are $30. If the price doubles from 90 to 180, the rents go up from 30 to 120. So the price has doubled and the rents have quadrupled. Your question about managing booms and basically ring fencing revenues into some political structure which says these revenues must be used only for assets. I think that's enormously valuable. Without it, I don't see politically how natural resource-rich countries can operate their natural resources sustainably. There has to be some commitment technology for ring fencing to confine revenues, to protect them for assets. And the irony is that the IMF has spent a lot of time building commitment technologies around budgets for the OECD. It fought these battles in the 1960s and 70s, and it won its battles, but it was fighting a different war, because the OECD countries, on the whole, are not resource-rich. And so they don't have this problem of an unsustainable source of revenue and how to protect the money so that it's only used for assets. The war that the IMF was fighting in OECD countries was to protect what it called an integrated budget, to avoid revenues being hypothecated for particular political lobbies. So it wanted to avoid the lobby for schools saying, we're going to use all the taxes on garments to earmark them for schools, or something like that, the hypothecated revenues. And it was very sensible to avoid that earmarking. The problem is that having got that sensible idea, the IMF then it became an ideology, a sort of religious tenet, detached from the understanding of the problem it was designed to solve. And so the idea of no ring fencing of revenues became a sort of ideological proposition, even when you get a context in which ring fencing revenues for assets is absolutely vital. And so there is an internal discussion within the IMF as to do we stick to the ideology, or do we actually go back to understanding when do we need commitment technologies and what are they for? Once you reframe it as what commitment technologies are needed, it's blindingly obvious that resource-rich countries need commitment technologies to make sure that revenues can only be used for assets. Similarly, with borrowing, borrowing needs to be subject to the same ring fencing. Often the two are linked because implicitly the borrowing is collateralized with the natural resource revenues.
So it can actually be attached to the management of the sovereign wealth fund.
Yes, absolutely.
Investment is financing.
That's right.
So capital market borrowing would be also restricted to investment.
That's right. That's right.
Yes, please, your questions, and just to give opportunity to others, just keep your questions short and focused. Thank you. Mariangela.
Hi, thank you very much for your presentation. I just had a question. I found it very interesting, your idea of building capacity and investing in investing. Good domestic public investment. I would love if you could elaborate a little bit what you mean with that. If it's kind of different from what you mentioned at the end of your presentation of the international arena on that. Thank you.
Yes, sure. Maybe two more questions. Is there any other question? Please.
I think it's me, sorry. I'll just go ahead and ask my question. Sorry. My question was regarding the sovereign wealth funds. So I found it very convincing how you said that for a low-income country, it wouldn't make sense to park their rents from resources in these sovereign wealth funds. But my question was, to my understanding, it also sovereign wealth funds are a way of handling the inflationary pressures that come with resource rents and their investment in the domestic economy. How would you deal with this problem if you invest in assets in the domestic economy? Thank you.
Push this one, the button on. Can you move to maybe try that one?
The button under the microphone. Hello. Regarding publishing percentages of resource rents invested back into countries, who would be responsible for this? Would it be third-party international organizations or national governments? And the reason I find that question so important is because it seems to me that the countries that need this information published the most would also be some countries that have the least transparency.
So the first question was what in practice does investing in investing mean? Building the capacity to invest. And if we think through public investment, the typical project has 4 phases. We've got to design it, we've got to select from a number of different possible projects. We select this one and say we don't do this one. So there's design, there's selection, then there's implementation. You've actually got to build the project. And then finally, you've got to evaluate. Did it do, did it work? All 4 of those phases require government capacity. Fortunately, this is something I work with the IMF, and in 2011, they actually benchmarked 73 countries on each of these 4 components of public investment capacity, and it's on a website. If you go onto the IMF website, just Google Public Investment Management Index, and it will pop up for 73 countries, these 4 different aspects. And each one is graded on I think, a 5-point scale. And the amazing thing is that countries differ a lot, even in each of these components. So, for example, I looked at Francophone West Africa recently, and the typical Francophone West African country came out looking pretty poor, but if you took the best, the best of the Francophone African countries on project selection, the best on implementation, the best on design, and the best on evaluation, you'd have had a country that was ranking about 4th or 5th in the world. So there's a lot of scope for learning from neighbours, really. So that's investing in investing. There's a good question about the sovereign wealth fund and inflationary processes. So, yes, you're quite right that there are really 2 aspects to this. The aspect I've discussed is if you like, the microeconomic point that that you're crazy holding assets in financial claims on investment in America if you're Guinea and you're desperately short of investment yourself. Because properly done, the rate of return on investment in Guinea has to be higher than what you can earn holding financial assets in America. So that's the micro point. But if you were to suddenly scale up investment in Guinea, treble it from one year to the next, then you'd get inflationary pressure in the country. You'd also get pretty lousily implemented investment projects, obviously. So what's the right approach here? It's a sequence. You first do this investing in investing, which is building the capacity to invest well. Until you've done that, put the money abroad. Once you've built the capacity to invest well, then you do the investment. You scale up investment. Not all at once, but you build your investment up at maybe 20–25% a year. As you've built your investment, you've therefore built the supply capacity of the economy. And at that stage, as you build the supply capacity of the economy, you can also increase demand in the economy without driving prices up. So the solution to Dutch disease is the big concept here. And the analytic failure in thinking about Dutch disease was that it was thought about in a static framework, where the capital stock in the country was implicitly constant. And so Dutch disease occurred because you raised demand for a given supply. And all you could do was shuffle supply between tradable and non-tradable goods. But in a dynamic context, you can increase the entire supply of the economy by using the first revenue flows to increase investment rather than consumption. As you've increased investment, you can then increase consumption without Dutch disease. So that was a rather technical answer, but I think you look as if you followed it, so hopefully it was all right. Good question. Who should publish the data? I think this is entirely a sort of cooperative process. The international financial institutions work with countries on their budgets, on their budgeting. And so the concepts used in budgeting are basically international standard concepts. And so the concepts for what is per capita revenue from natural resources, how much of revenues are actually used for assets. These need to be internationally standard concepts, which then a government just applies in the normal way, and out comes the number. And so it's not that some foreign agency should come in and do the calculation itself, nor is it that the country should invent the wheel independently. It's that the conceptual toolkit, how to measure this number, should be a global public good. And then countries with natural resources just automatically do it as part of their budgeting. It would really be very useful for finance ministers to know that number, and for citizens to know it. And it would be useful for finance ministers if citizens knew it. That way, they could actually do what a lot of finance ministers want and actually use some of these revenues for the future.
We are really running out of time. Professor Collier has also an afternoon session. So just abusing my advantage of being at the podium, can I seek two clarifications on the response to that question? One is this absorptive capacity issue is really so prevalent in most countries whenever they try to scale up investment. But there is very little number or criterion which policymakers can use, or even technical planners can use, or the public to understand. Is there any number or indicator which can be used for, calibrating policies, scaling up investment to the absorptive capacity? The second clarification is on the Dutch disease. Often I think, these countries' resource endowment is, some of them are really long-term. They really have such resources that their competitive advantage is determined by the resource abundance. And the Dutch disease is not really a disease, it's almost a permanent feature. You are born with it. And often countries, even such very largely endowed countries, are advised to seek diversification and other industrial policies. And the argument is used is, this is the Dutch disease, you have to do it. And sometimes it seems to push countries into, all kinds of misguided industrial policies. What's your...
Can I abuse my privilege to finalize? So since it's part of the financing for development process, if you could end with your thoughts on the one or two most important commitments that ministers and heads of government could make in Addis Ababa in July, that would be great. Thank you.
Okay, so absorptive capacity, the key to understanding absorptive capacity is that absorptive capacity changes depending upon how much investment you do. And so if you're up against a constraint on absorptive capacity this year, as long as you increase investment in things that are productive, next year you'll have greater absorptive capacity. And so the way out of the conundrum is indeed investment. So absorptive capacity is not a given fixed entity, it's something that depends upon how much investment you do. Your point about Dutch disease and diversification is absolutely right, that it's become a sort of obsession, the idea that you should diversify. It struck me about 10 years ago, I was asked to join an IMF mission to a little country that had just discovered an awful lot of oil. And the IMF mission chief said, we've really got to go and discuss diversification strategies with them. And this little country had discovered enough oil that it was going to be it was going to have its exports taken care of for a lifetime. And so what was actually important was not developing other export industries. What was vital was building the capacity to produce what economists call the non-tradable goods, the goods which couldn't be imported. So, for example, people were going to be a lot richer thanks to this oil, and so their housing would need to be improved. But you can't import houses. You've got to build them. And so instead of diversifying the economy into some new sets of industrial exports or something, the vital thing was to scale up the construction sector so that you could actually build things that people on a higher level of income would want. And so this mantra of diversification was very befuddling. People had just got the wrong end of the stick, you know? It's like integrated budgets. It becomes an ideology detached from the underlying rationale. The underlying rationale for worrying about Dutch disease is if your resources are not going to last for very long. If they're going to last for, say, 25 or 30 years, it's premature to diversify now. What you need to do is to build platforms which will enable you to diversify later. And the perfect platform, you know, we can't tell what will be the opportunities for exports in 30 years. Right? But we can predict pretty well what will be a good platform, almost regardless of what your opportunities will be. And that platform is an efficient city. And so investing in efficient urbanization is a really good way of preparing for a future of diversification. So there are sort of one class of country, forget about diversification, you'll never need to do it. One class of country, these things are really temporary, you better start diversifying now. And a big group of countries, you don't have to worry about it for this generation, but you do have to worry about it next generation, in which case you need these platforms off which you can jump in the future. And the most obvious platforms are efficient cities and an educated population. If you've got an efficient city and an educated workforce, you'll be all right in the second half of the 21st century. Now, there was the impossible question, what's a wish list, right? And let me start with a modest practical wish list of saying the two numbers that I've recommended, natural resource revenues per person and how much is saved out of those revenues, that would definitely be on my wish list. These are doable, measurable numbers that are fundamental for sustainability. You know? Beyond that, I think managing foreign private inflows in such a way that they actually build a sustainable future, partly that means this ring-fencing technologies that commit publicly revenues raised from debt, public debt, that commit them to investment. And partly the structures I was suggesting that would attract private investment into infrastructure, but do so at rates of return which are not audacious. And that means the commitment technologies that de-risk the infrastructure so that this can be held by patient pension funds rather than rapacious private equity. So there's a wish list.
Let me thank...
Finally, IBRD. That's really important. IBRD has got to be rethought so that it becomes open to low-income countries.
Thank you very much. And we've taken very careful notes, and we will forward our notes to the negotiators. And also, if you think of any other things, please email us.
Thank you very much.
Just in case. And thank you for your attendance.
Thank you. Bye-bye.